discuss risk management. Risk management and how it's beneficial to you, because I know sometimes we can lose track of what we're doing in the market. So let's dive straight into the video. Now, risk management is all about how you what lot size you use in the market, and it's basically, to put it in layman's terms, it's basically, you're going to your job all month and then you get paid. So it's how you use your money throughout the month. So it's about how you manage your account after you've made the initial deposit. Now, so, some people trade a 1-to-1, some people trade a 1-to-2, but the best way, or the best risk to reward, is a 1-to-3. Now, what does that look like? It means that you are risking 1% to make 3%. So you're risking 1% of your account to make 3%, or to make 30%, or 10% to make 30%. So it's basically risking 1% to make 3%. So why is that the best risk to reward? So if you risk 1% per trade because you want to gain 3% on each and every trade, what that basically means is that if you had to take, let's say you took 10 trades per week, out of that 10 trades, you lost, okay? You lost 7 trades. So you're down 7% for the week. And you win only 3% of that. So we've got a negative 7 and we got a plus 3%. That means overall for the week we would then take 3 times 3, that would give you 9%. Sorry about that. So it will give you 9%. So you would still be in a profit of 2% at the end of the day. But remember, this requires you to use to not be inconsistent with your lot sizes. That means that you shouldn't use the thing called revenge trading, where you trade 0.01, for instance, or you trade a 0.01 and you lose, and then you go 0.02, now you lose, then you go, oh my god, I need to make back all the money that I lost. 0.03, then you lose. Now just when you see your account is starting to is now starting to decrease, now you want to go, okay, let me rather go back to 0.01, and then you win, but now you only win like $20, for instance, and you go, oh my god, I've already lost $70, I can't be working with $20, I need to go and make the big money, I want to become a millionaire overnight. And then you go, and because you feel deep down inside of you, you feel, oh my god, I want to get back at the markets because they've taken my money all day. Then you go 0.010 sure shot, because someone out there told you that this is a definite shot in the market that's gonna be the game changer, and you can already start thinking about how you're gonna stand on your GTI and how you're gonna take photos of yourself and your Rolexes and all of your stuff, and you go 0.010. You put your phone down, you start going outside, you tell yourself, I don't want to check my phone, I don't want to check my phone. Unfortunately, you come back and the market said, you know what, it's not your day today, buddy, because because you cannot handle manage your risk effectively. We're going to punish you for that. And the market rips out your entire account. And now you feel a certain way because you feel like you need to deposit again, because you feel like you need to make back the money. And that's got a lot to do with trading psychology, which has got a direct confluence with managing your risk as well. It's important that you understand which lot sizes you need to trade based on where your account balance is at. So if your account is starting at $100, what you want to do is you want to calculate your position size first based off what your entry or take profit and stop losses is. Now, this is a Nest market tool that I like to use all the time to calculate my risk. So for instance, I want to risk 1% of my account in general. So I want to risk 1% of my account, right? So what I basically do is I come and I say, okay, 1% of my account is going to be $100. Am I comfortable with losing $100? Yes, I'm fine. So then the next thing you want to do is you want to come back to the pair that you do want to take the trade on. Sorry about that. And you want to come here and you want to say, okay, I want to buy a UD cat from this level. Double click on it. So you take your entry price, you put your entry price in there, would come back, take your take profit level, put your take profit level in there, and then put your stop loss, which is the last one, your stop level. Take your stop level and then drop your stop level in there. Once you've done all of that, all you do is calculate your position. There it tells me I need to use 0.17, and my when my stop gets hit, I'll be down $100. Am I happy with that? Yes, I'm fine. I'm fine with that. So let's say my account drops to 9,000 because I've just lost, I've just lost $100. So now I'm taking my next trade also based off 1% risk. So now I come back and they say, okay, it's still fine. You can go with 17 lot again. Now let's say I drop down to 8,000 because I'm now 2,000 down because I'm being very aggressive. So sorry, so we just go 1% again. So now it's going to tell me your risk is now 0.13. So that allows me to scale my lot sizes in terms of what my actual account balance is. Now, one thing I do want to speak about also is funded accounts. So if you do think of taking up a funding account and you are going to make use of this tool, what you don't want to do is, if you do sign up for a 10,000 or 20,000, 50,000, 100,000 account, you cannot put in here 10,000 purely based off the fact that your account is a $10,000 account. Because why? You are not paying for a $10,000 account because your overall risk is only $1,200. Because why? If you lose $1,200, that means you will be kicked out and you will lose your money. So if you are going to make use of this calculator, don't go put in there 10,000. You need to trade based off what you can afford to, or what you can risk. So that is basically $1,200. So you're actually paying for an account of $1,200, because once you exceed this, then there's a violation detected on your account. Also, make sure that you understand this daily drawdown as well, because if your account runs over a drawdown of $500, then you will also be in violation. So imagine you put in there 10,000, and 10,000 is equivalent to 10 pips, for instance. That's going to be at $500. Then you are even more screwed, because now you've taken in a you've basically taken in account a lot size that was not in line with what you are able to risk on here. So just make sure that you understand this as well, that you want to make sure that you calculate it based off your daily drawdown and your overall drawdown as well, understanding what the equity is for that day, so that you don't go and put there 10,000 or 9,000, because you don't have 9,000 or 10,000 to risk. This doesn't get You don't come in breach of the contract once the 10,000 is done. No, once the $500 of drawdown is done for the day, you're out. Once you have an overall drawdown of 1,200, then you're out as well. So just make sure that you keep that in mind as well, because I see a lot of people, they like to to put in the 10,000 in there as well. Now, I hope you guys have found this video useful. I hope you guys have found this video useful. Also, if you are new here, don't forget to smash that subscribe button. A like would be really appreciated. Please let me know down in the comments below which video it is that you would like for me to discuss next as well. Thank you so much for your time. Cheers for ears.